Can you stomach the roller coaster ride in global stock markets? And if you can, should it be buy, hold, or sell?
If you are a long-term investor in general, if prices come down, it's a better time to buy than to sell.
The big question now is whether the sell-off is just temporary.
It is really looking more like a correction than a large drawdown or bear market. So I feel like it's more a natural course of rebalancing evaluations.
Well, the Fed hasn't cut rates yet. They still can make certain decisions, and that can also help the markets. The Fed can surprise with a larger than expected rate cut. So there are still many factors that can come in before you can officially say there's a recession. But I think right now, definitely we can see there's a huge concern with investors taking risk off the table.
One thing to look out for is a drastic decline in big tech. These stocks make up a big chunk of major indices and could potentially drag markets into bear territory. That's when markets fall 20% or more. Analysts at Fitch Solutions firm BMI say that can happen if US equities fall below key levels of technical support and credit spreads continue to widen and signal a further downside.
Some may adopt technical analysis and they may look at certain key support areas where those price levels are very important for prices to stay above. For example, 200-day moving average, if the prices fall below that, then they deem it as a bear market. So there can be many definitions, many indicators, and one thing to know is that none of these indicators are 100%.
Concerns also hover around weak US economic data and the Fed falling behind the policy curve, as well as heightened tensions in the Middle East and North Africa that could lead to higher oil prices and geopolitical uncertainties. For now, investors should relook their portfolios to brace for any potential market shock.
Investors should definitely be owning stocks. They should be buying it in a globally diversified manner, either through index funds or systematic globally diversified funds. They should consider also holding some fixed income to balance out the risk of stocks if their risk tolerance is a bit lower. You should only be selling investments that you feel either don't make sense for your portfolio right now, or if you need the capital to fund some kind of a life goal.
Investors can turn to sectors and asset classes that are expected to outperform in the current environment.
Majority of the global banks are actually on the path of easing, so it will actually benefit bonds in terms of the outperformance, especially from medium term to longer tenure bonds, okay, due to the duration factor. In terms of the FX market, we start to see potential safe haven currency that continues to actually outperform from a medium term to short term perspective, which will be the Swiss franc and as well as the Japanese yen. If you look at the Japanese market right now, despite that tremendous sell-off, overall, it actually lead to a much more attractive valuation. And secondly, given the fact that the yen is potentially able to outperform, that could actually attract international investors back to the Japanese stock market again.
A surprise hike that boosted the Japanese yen, weak US jobs data, and a summer of typical low liquidity are being blamed for the market meltdown. But there are far deeper risks that can pull markets down in the coming months.
There will be still a risk of an increased volatility, the US presidential election risk, number one. Secondly, we also do see a geopolitical risk as well that is still lingering around the corner due to this ongoing fluid situation in the Middle East between this ongoing conflict in Gaza, which could actually also potentially trigger a spike up in oil prices as well.
Weak US jobs data is stoking recession fears, so investors are looking to the Fed for more action on interest rate cuts.
These are indicators that the US economy might be slowing down, and a lot of economists are concerned that if the US economy slows down and the Fed keeps rates at a restrictive level, what that means is that companies will struggle in a harsher business environment, and that won't be so good for companies' business and profits.
Expectations of a steeper economic slowdown compounded the sell-off in the tech-heavy Nasdaq Composite Index, which fell 10% from its July high after the weak jobs report. And there could be more downside.
The mega cap tangent stock is driven by AI optimism. At this moment in time, AI is not a profit center yet. It's still more of a cost center at this juncture. Everything is still based on an expectation, unless we could start to see that this AI is being transformed to like the internet during the late 2000 and 2001, and people will start to embrace AI as part of their business operation.
I do think that there is room for more of the big tech stocks prices to come down because they have been more overvalued since the last year, right? For over a year, and it's time for them to have a healthy correction.
Volatility aside, experts say the biggest risk is not being invested, regardless of market conditions.
Even if we are in a situation where the outlook for the economy is deteriorating and therefore the share price of equities will not be as strong, I think investors will still need a disciplined mentality to continue to be invested in the markets, because history has told us that being in the markets is much better than trying to time the markets.